Okay, that's done. So welcome everybody. This is Mary Peabody. You might have been expecting to hear from Jessie Schmidt, but she's snowbound at home and is joining us as she's able on her connection, but it's not fast enough to keep up with the audio. So I'm going to be the moderator, and Dennis Coppola from UVM Extension in St. Johnsbury is our presenter tonight, but as I already said, his internet connection is a little bit unstable. And the reason I'm laughing is because some of you may know we've already postponed this once for technical difficulties. And so we are determined that we are going to get through it tonight, no matter what. So I'm going to advance the slides. Dennis is going to talk, and you all are going to post your questions in the chat box. And we'll try to keep the microphones off because it feels like there's a lot of background interference tonight. And that could be weather related, it could be technology, who knows. But anyway, if you just bear with us, post your questions as you have them. I'll interrupt Dennis and we'll sort of do this. It may feel a little clunky, but we'll get through it and you'll get some good information. So this is our monthly webinar series. Again, as I said, it's usually it's a little off timing-wise just because of the technical difficulty, but tonight we're talking about taxes and beginning farmers. And Dennis, I'll let you take it away and you can introduce yourself.
Okay, thanks, Mary. Like Mary said, my name is Dennis Coppola. I'm faculty member with UVM Extension based in St. Johnsbury, northeastern part of Vermont. Started with Extension in 1983 and started doing some tax stuff very shortly after that. And now have been pretty involved with tax work for a number of years. And the topic this evening is taxes and beginning farmers. So I'll give you my best shot. Next slide, please, Mary. You should be taking a look at the cover of the Farmer's Tax Guide. This is an IRS publication, Pub 225. Like a lot of IRS publications, it's not meant to be read cover to cover, but it does give good information in there. There's about 15 of us extension folks from around the country that meet with IRS every May for a day or two. We review the chapter or the Farmer's Tax Guide from beginning to end, make suggestions to them about readability, making the examples more current and stuff like that. And they do listen to some of the stuff that we say. The Farmer's Tax Guide is downloadable as one PDF file if you'd like to, or you can open the different chapters, download them, or read through them. It's a good idea, I think, for everybody to take a look at Chapter 4, at least, Farm Business Expenses, to make sure that you are claiming all of the farm business expenses that you can. One of the things that has happened in the last couple of years with IRS, they're trying to lower their cost of operation like so many are. And one of the things that is not in the Farmer's Tax Guide anymore that used to be is a comprehensive farm example with all of the forms filled out. And so you can see how a number on this form gets transferred over to that certain line on the next form. And because they weren't printing that, we kept teasing them for a couple of years to bring that back, and they said no. So now that stuff, a comprehensive example, is up on a website, ruraltax.org, and I've got that written out on one of the later slides. I think it's the very last one, but it's an easy one. It's www.ruraltax.org, and there's some other more farmer-friendly tax-related publications that we've put up onto that website that you might be interested in. The IRS website does have, you can get all of the forms and all the publications right there, and it's a pretty easy to maneuver website. So I encourage you to take a look at that. Next slide, please.
We're there.
Okay. Let me get there too. There. Tonight we're going to cover some income tax basics. We're not going to be talking a lot about percentages and stuff. We're going to be talking about the concepts involved and what to do about it. Some of the things that we're going to be talking about are startup decisions, starting up your business, farm business, thinking about what you're doing. Is it a hobby or is it a business? Talking some about farm business income and expenses, tipping our hat to depreciation, making you aware of the fact that selling business property is somewhat different than regular income, talking a little bit about employer and employee issues, and self-employment tax. I guess the next slide, please.
Okay.
First off, a little bit about types of taxes. There are several different types of taxes. The left-hand column is taxes that you as a person may well be familiar with already if you're not running a business. And then the right-hand column is taxes that businesses only find themselves dealing with. People have to pay state and federal income tax on earned income, whether it's wages or salary or what have you. And lots of times that's withheld from your pay. Property owners, in Vermont anyway, have to pay property taxes. If a person like you or I sells something, say a house or a mutual fund or a different piece of real estate, we're apt to owe taxes on the gain from that asset sale. And then there's also estate taxes that may be due on our estate after we die if we've accumulated a lot of property in our lifetime. Perhaps you've run across that when your parent died or when some other relative died or something like that. And then I would imagine that you have heard about the estate tax in the last few months when the Congress passed the Tax Act back in late December. The estate tax was a big political football. It's sometimes also called the death tax. Businesses only have to pay tax on their profit, and they calculate profit using a Schedule C for most all businesses or a Schedule F for farm businesses. And then the profit from that business winds up on your individual 1040 and you pay taxes on that. Self-employed business owners have to pay a self-employment tax, which is very similar to the Social Security and Medicare taxes that wage earners pay. One difference is that wage earners pay a half of that, and self-employed people pay both halves, both the employer's share and the employee's share because they're self-employed. Businesses also may face employer paperwork, which can get fairly involved if you hire people to work for you. A farm business in Vermont may have to collect and pay a sales tax if they're selling non-food items. And then some farms in Vermont do pay excise taxes if they're selling fuel or alcohol. There's wineries and some places that make cider, and they have to pay excise tax on that. Next slide. Some of the decisions that people face when they start up a farm business, some of these things are obvious and some of the things are not quite so obvious. The first one is choice of entity, and we can start doing business, and if we haven't made a selection as to the choice of entity, we default into being a sole proprietor. If we start doing business with somebody else, we've got a partnership, and if you find yourself in a partnership, it does pay to talk about it and have a good partnership agreement so that you know what you're getting into and you have a good understanding of how to get out of it. And the same goes for an LLC, limited liability company, or an LLP, limited liability partnership, or a corporation. Most of the farms in Vermont are sole proprietors or partnerships or LLCs. LLCs are quite similar to a partnership. They do offer some liability protection, but in order for them to offer liability protection, you as an owner have to follow what you said you're going to do in terms of keeping business and personal funds separate and reporting and stuff. The next item here is how to keep financial records. You got to keep them. You got to keep them, so you might as well find a system that you're comfortable with. You got to keep them up to date, and they can help you if you keep them up to date, or they can be a major pain in the butt if you wait until February 2 to try to start recording income and business expenses for January of 2010. That's a bummer. If you try to play catch-up ball like that, you may forget to record some of your deductible expenses, and then you're claiming too much income. I guess there's three major record-keeping systems come to my mind. One is a manual system, some kind of a ledger book. There's a farm account book that a lot of people in the state have used and throughout New England have used. Then there's the El Cheapo program, something like Quicken, which is a cash-based program that can work for farms, but if you have to send invoices out, it cannot deal with an invoice, because an invoice is not a cash-based item. It's somebody owes you money, so you're billing them, and Quicken can't handle that. Ohio State and Oklahoma State extensions have excellent Quicken material to help get a farm set up onto Quicken and use it right. The next one would be, the next step up from Quicken would be something like QuickBooks or Peachtree. That's a more sophisticated accounting system that can handle invoicing. QuickBooks can do balance sheets, but you've got to watch it because they aren't real good farm balance sheets. If you're computer literate, it'll work well. If you aren't so computer literate, you can hire somebody to come and help you get set up on Quicken. I know that a number of accountants will come to the farm and get you set up properly on QuickBooks the first time so that you aren't floundering around quite a bit. Some people that like Excel can set stuff up with Excel. The challenge with Excel is that Excel is a good recording system like Ledger Book is, but the reporting that you ask these things to do, you have to fool with it quite a bit to get a report out. compared to Quicken or QuickBooks. And then Yankee Farm Credit sells a program that's called QuickCheck, and that's specifically for farms that does a very nice job as well.
So Dennis,
yeah.
is for the folks that are not in Vermont necessarily, is there an equivalent to Yankee Farm Credit in other states?
There are farm credit lenders across the country. Some of the farm credits do more financial services than others. I believe that Yankee and the ones in New England offer a number of financial services, including QuickBooks and QuickCheck consulting. I'm not sure of the ones in the Midwest and stuff like that.
So if you just go on the internet or look in your phone book for farm credit, and you'd find what's going on.
Yeah, you could probably Google farm
extension.
credit services and then put your state in there and find out what's happening in your state. The farm credits are co-ops whose main purpose is to lend money to farmers, and it's a national system, but each state or group of states has separate entities that do that. Does that answer that?
It does, and I've got a couple of questions here.
Sure.
Do you want me to run them by you?
Yeah,
one of them is an employee-employer question, so you might want to put
we'll get to that later. Yeah.
But and then the other one is on checking accounts.
Oh yeah, that's a good one. Yeah.
It's does the checking account have to be a business account as opposed to an account in your name for the farm?
Good question. I meant to mention something about this. What works very well is to have two accounts, one personal account and one business account. And that helps to make it easier to separate the piles of cash so that when you've got a checkbook in front of you, you know what that is and you know the types of transactions you should be doing from that account.
Okay.
So I'd suggest you have a personal and a business, and then if the farm needs some more cash, you could put money into it from your own account, but you'd be able to track that easily. And if your family needs cash from the farm, you'd be able to write a check from your farm book and deposit that into your family account in order to live on. And it'd be easy to track that money. Any other ones?
Yeah, we've got another one on Schedule C, Schedule F, so I'll hold that one for a few slides.
Yeah, that's coming up in a minute. Those are good ones.
Okay.
That's gray soup area there.
So are we ready to advance? Are we off startup decisions?
Registering your name with the Secretary of State. Sole proprietors work under their own name, and there's no need to record it. In Vermont, it costs about $50 to register your business name and protect that name. The state of Vermont, the Secretary of State's website in Vermont has a place where you can scroll through and look to see if another business is already using the name that you would like to use. And once you register a name in the state of Vermont, it lasts for 5 years. So it's helpful to be able to look at that. The Secretary of State's website in Vermont is very, very good. There's a lot of information about LLCs and partnerships and lots of different stuff in there. And then open the business checking account. We just talked about that. Okay, next slide, please. Hobby or business? Bingo, there we are. The Farmer's Tax Guide doesn't really say hobby very much. What they call it is not-for-profit farming. But what happens with a lot of the farms that I'm familiar with is that people start raising something or start growing some stuff and then find that they've got more than what they need, and they find out that they can sell some of it, and then all of a sudden they're selling more of it, and pretty soon they're wondering, is this a business or is this a hobby or what is this? If you're operating as a farm business for profit, you can deduct all of your expenses, legitimate expenses, on your Schedule F, and you report all of your income on the Schedule F also, the farm form. If you're doing it for a hobby or not for profit, all hobbies, this is kind of surprising, all hobbies you're supposed to report income on your personal 1040, and then there's a limit on how many expenses you can claim, and you've got to list those expenses, list the expenses on Schedule A, which is the itemized deductions form. And if you're farming if you've got a farm business, there's an expectation that you will be making a profit every so often, and if you're not and are claiming loss after loss after loss, IRS might get concerned, and there's 9 factors, in fact, listed in the Farmer's Tax Guide that IRS uses to determine whether or not you've got a business or a hobby. And so you've got to keep an eye on things and have goals. What's your goal? Is this a hobby or is this a business? I like to garden a lot, and I know it's a hobby. People ask me if I sell stuff, and I say no. This is a hobby that I enjoy, and I'm not looking for income from this thing. Next slide, please.
Okay.
What is a farm? IRS has very specific definitions as to what a farm is. It's the business of farming is cultivating, operating, or managing a farm for profit. And then they go through with lists of what is included in this: livestock, dairy, poultry, fish, fruit, and truck farms, fish farms, plant nurseries, orchards, plantations, ranches, greenhouses, and bees. And IRS, actually in the Farmer's Tax Guide, there's page 1, 28, 74, 81, and 84. There's 5 different places where they talk about what is a farm. And the stuff that isn't specifically listed isn't a farm in the eyes of IRS. If you're a farm, you use the Schedule F. If you're not a farm, you use the Schedule C, like all other businesses in the country use. There's a very unusual thing here in Vermont. Well, part of the a number of farms now are bringing processing into their farm operation. They're not just producing a product that they've grown, but they might be making something from that product, whether it's a sauce or pickles or cheese or sausage or other stuff like that. The producing the crop,
or fiber products.
Yeah, fiber products. Yep. Producing the crop is a farm, and processing it is Schedule C, a different business. In Vermont, if you producing sap and selling it, that's a Schedule F enterprise you've got, because you're producing sap. If you're producing sap and processing it to syrup, you're really supposed to be filing a Schedule C, because the processing is creating most of the value of that product. But if the maple business is a part of the farm operation, then you could include the maple enterprise on your Schedule F. And then if you are buying sap and processing it to syrup, that would be a Schedule C enterprise, I guess. And the same is true with farm tourism, agritourism. If you're bringing people onto your farm and receiving money for it, that agritourism part is a Schedule C business. What's the advantage of a Schedule F or a Schedule C? Schedule C businesses can use more rapid depreciation. Schedule F, farm businesses don't have to, let me see, they don't have to make quarterly self-employment tax payments, and that's two of the biggest things. So it's kind of unusual, but that's just the way it is. Let's see. Was there a question on that one, Mary, from before?
There was. I think you answered it. I just asked. Jack and Mary Ellen had asked the question. They've got some fiber products, handcrafted goods and country collectibles. It's a business, but for now they're supplementing day jobs. Would they be better off filing on Schedule C or Schedule F? And if I heard you correctly, it sounds like it's a Schedule C.
It sounds like it's a Schedule C, yeah. And the amount of tax is the same. So that, those are the big ones, the self-employment tax and the depreciation.
And they say amen to the gray soup.
Yeah, amen. Yeah. Is that the Franklins down there? Mary Ellen? Was it Mary Ellen and somebody else you said?
Jack and Mary Ellen, yeah.
Okay. Shearing, you can do custom work and include it on a Schedule F, like shearing sheep is probably a Schedule F item. If you're raising sheep and then you go out and shear some, that's a custom work income that would be on a Schedule F, probably on line 9. I was on a farm yesterday and they did some sawdust hauling and they put it on the Schedule F. Some farms might do some custom baling or rototilling and stuff like that, and that can go on to a Schedule F as long as it's not the major part of your business. Next slide, please.
Okay.
Farm records and tax reports. You may or may not be able to see this IRS pub. It's publication 583, starting a business and keeping records. It's another PDF file that you'd be able to take a look at. The main thing that IRS needs to have, or needs you to have, is a categorized list of income and expenses, and then they expect you to keep that stuff for 7 years. IRS can audit, they can go back and audit your records or audit your tax return and associated records for 3 years unless there's fraud, and then unless they think there's fraud involved, and then they can go back further. And then for tractors or other equipment that you might buy, the suggestion is to keep the records on that equipment for 3 years after the machine is gone, because the first of those years it would still be appearing on your tax records. The next thing you need after the list of incomes and expenses, stuff you sold and stuff you purchased, is a list of assets that you bought and sold or traded with the date that those things happened and the amounts that you paid for it or received for it, so that you or a tax person can keep track of capital gains and depreciation. The next line should say 1099 instead of 1009, and 1099 information returns are stuff like interest. There might be some USDA program money, or there might be other income that you've received from people, or you might have to give a 1099 to people that you do business with and have paid more than $600 to in the course of the year for their services that they've provided to you. The next thing that you have to keep a record of is payroll information, including stuff like hours worked, amount paid, and payroll deductions that you have withheld from employees. It's useful to keep an inventory of stuff that's on hand at the beginning of each year, and you'd want to definitely keep a record of accounts receivable, which is money that people owe you at the beginning of each year, so you can try to get that money. With all these records, the more detail you have, the better off you are in terms of understanding what's happening. Categorized list of incomes and expenses. Mary and I were talking about this a couple of weeks ago at the Building a Sustainable Business class. This is cash flow statements, and profit and loss statements are based on accurate lists of incomes and expenses that show what happened to the business during the course of the year. The last 2 weeks ago when we started with this program but weren't able to complete it, we had a question about assets, and somebody had bought the tractor 3 years ago and didn't have a business, and then they started a business and began using this tractor for business use, and you would be able to start depreciating that tractor when you convert it to business use is the term. And what you'd use as starting basis for depreciation is the smaller of either the purchase price or the fair market value on the date of conversion from hobby to business use. And I know that happens a lot, that people have an inventory of stuff and then they figure that, well, this is a business now, and they bring this stuff in and just start using it, and some of those assets they might be able to depreciate. And depreciation is a non-cash expense that shows up on a business return as we'll get into that a little bit more.
So we've got a couple questions here
Good.
that might fit here.
Yeah.
Let's see, we did that one. Here's a related question. If any farm purchases such as tractors or livestock were made before the business was registered, can they still be written off as expenses afterwards?
Registering with the Secretary of State doesn't. I don't think that determines.
Doesn't impact that.
I don't think that determines
Right.
when the business began. It's when you think the business began and when you begin keeping records for the business instead of just keeping scattered records that you would in a hobby.
Yeah, registering the business with the Secretary of State simply just protects that name for you, and it's only for a period of time. You'll have to go in and re-register it after some.
I think it's
3
5 years in Vermont.
5 years,
yeah.
okay.
Yeah.
So it protects your name, and that's really all that it does.
And there's a lot of people that are doing business out there as sole proprietors with no name registered with the Secretary of State, and they've been using the Schedule F for decades. They're just out there farming and under their own name.
So let me ask you this other question, because this is another Schedule C, Schedule F question.
Oh yeah.
And it has to do with canned goods made using primarily homegrown ingredients from the farm.
Here we are in the gray soup area.
Yeah.
I guess it depends on, is more of the value, more of the income of the business coming from the canned stuff or coming from the fresh product that you sell, either from a roadside stand or a CSA or a farmer's market. And I'd kind of let that be the guide as to, is this a Schedule C or a Schedule F. So,
and this is where I'll do my little mini PSA and say, that the advice that we're giving you here tonight, should not be a substitute for talking to a bookkeeper or an accountant or your own tax preparer at some point in time. And I think that the trick with all of these things, and especially with these gray soup areas, is consistency over time. It's more important that whatever way you do it, you continue to do it, versus just switching back and forth and trying it one way for a year and then trying it a different way and then back and forth, because that sort of catches the eye of the IRS.
Yeah, this is an educational evening here, hopefully.
Well, I'm getting educated.
Good.
And let's see, the 9 criteria for defining a farm or business.
Oh, yeah.
Back in the Farmer's Tax Guide, right?
Yeah.
Yeah.
Let me see. That's page 27 of the Farmer's Tax Guide.
Page 27. Okay.
Yeah, I don't know. Are you interested in hearing about that now, or if we've got time at the end, we could get into
At the
that?
end we can, because we do have a fact sheet on that, so we can make sure that gets in people's hands. Okay, and then yep, this is my first year officially farming, and I bought equipment, etc. last year. Can I still write it off?
Yeah. Yes, you can. You can depreciate that stuff with using the fair market value at the beginning of the year, either whichever is less, the purchase price that you paid for it. I guess it would be in 2009, or the fair market value on the date when you brought it into the business. And if you bought the stuff in 2009, it doesn't seem very likely that it would have decreased in value very much from sometime in 2009 until 2010. It may have, but it doesn't seem likely that it would have decreased very much.
Okay.
Okay. Let's see the next one.
Are we on to the next? Sorry, are we in the next slide?
Yeah. The next one is the 1040F or regular 1040 that you won't be able to read, but is included in those handouts. There was a little PDF file there. And the important thing is that all of the other forms, the numbers from them get brought into this individual tax return, the 1040. And all of your farm income, the profit or loss from the farm plops into line 18. About 2/3 of the way down on the first page of the 1040, line 18 is farm income or loss. Bingo! All your farm stuff gets smushed into one number and appears there. If you are using a Schedule C instead of a Schedule F, all of that stuff appears on line 12, business income. And then this kind of summarizes all of the tax stuff, and all of the other forms get attached to this form and either sent in or e-filed in. That's all that I wanted to show you on that one.
Off to business profit.
Off to business profit. Aha, there we are. Business profit is easy to calculate. Income minus expense. And then, like we just said, the profit moves on to 1040, and that profit then may get decreased by other personal deductions and exemptions and all those sorts of things, and then it winds up getting taxed by the feds and the state of Vermont or other states. So, and then there is no tax on business profits at the business level for sole proprietors, partnerships, or LLCs taxed as a partnership. The business profit from these types of businesses go right onto the people's 1040. Corporations and an LLC that has decided to be taxed as a corporation, there is a tax on corporate profits, and then those profits move from the corporation after taxes to the owners as dividends or something, and then the owners are taxed on those dividends as well. But there's no tax on business profits at the business level for sole proprietors, partnerships, and LLCs. Yeah, and hopefully your profit is a positive number, and if it's not a positive number, you can do that for a couple of years, but after several years, IRS can get concerned and start thinking about this. Is this a for-profit business? And if it's not a for-profit business, they will not allow you, they'll go back 3 years and say that these business expenses that you've claimed are not legitimate business expenses, and your income will be a lot higher. And you may have to pay, you may have to pay interest and some fines, as well as the back taxes. Next slide, please.
Okay.
Firm income. We'll take a look at the Schedule F here in a minute, but firm income is reported on the Part 1 of the Schedule F generally. It may be on Part 3 if you're doing accrual, but if you are using a Schedule F for accrual income, you'd be one of the 1% in the country that's doing that. All income from your normal farm business operations would appear on the front of that Schedule F right there. And it includes the list again from IRS says sale of products raised or grown, sales of farm products purchased for resale, income from farm-related services, payments from agricultural programs, and this includes barter. You're supposed to be claiming barter. Bartering is a great thing, but it's supposed to be included as income, and you're supposed to call it a normal sale and include the value of that bartering. And with IRS, this is money received during the year. If I sold you a ton of potatoes on December 31st, and you took the potatoes but didn't give me a check, I don't claim that as income when I sold you the potatoes. I claim the income when I received a check from you. So there is tax planning that people can do by using that date of December 31 or January 1. But most farmers are cash basis farmers, so they claim expenses when they pay for them, and they claim income when they receive the income. Let's see, sales of products raised or grown, that's obvious enough. Sales of farm products purchased for resale. I know there's, I was talking to a fellow that owns a greenhouse the other day, and they buy a lot of started plants and then raise them up to market size in their greenhouses, and that's items purchased for resale. Or if I bought a ton of potatoes from you to sell at my farm stand, that ton of potatoes would be an item that I purchased for resale. Income from farm-related services, that might be the shearing that we talked about, or the rototilling, or baling for somebody else, or any number of things that a service that I provide to somebody else, using my farm equipment, using my farm fuel, using my farm supplies, and I'm just doing it for you and getting paid for it, and I include that as ordinary farm income. Next slide. Oh, let me see. There's a.
I have just a barter question for you.
Sure. Yep.
So it says, if I pay my workers with produce, then I count this as the amount of money I would otherwise make if I sold the produce. For example, if I pay someone with $20 worth of produce, then I count this as $20 in employee pay?
Some of that stuff is included in pay, and some of it isn't. I think that would be included in pay. The value of, about 5 years or so ago, this was a big issue with IRS, and I believe that the value of the products that you pay that person in would be included as income to them. If you are providing them meals, the meal that they receive is not includable to them as income, but it's includable to you as an expense. And I know that I was a farm employee, and I was living in a house provided by the farm, and the I didn't claim that as income, the value of the dwelling, but they did include that as a farm expense. All of the expenses involved with that house, including repairs and property taxes and some fuel and stuff like that. So if you're paying them in product, yes, that's included by the employee. Yeah. You'd want to check in the Farmer's Tax Guide on there because there are some finer points on that thing, and I can't recall those finer points off the top of my head. This farm income is a whole chapter of farm income in the Farmer's Tax Guide on page 7 to 18 there. Any other questions on this?
Nope. I think we're caught up.
Next slide, please.
Mm-hmm.
Farm expenses. I'll run the quote by you and then talk about it a little bit again. These are all reported on Schedule F, and they're in alphabetical order. Ordinary and necessary costs of operating the farm for profit are deductible business expenses. And the list of things there is car and truck expenses, chemicals, conservation expenses, custom hire, depreciation, employee benefit programs, feed, fertilizer, freight and trucking, gasoline, fuel and oil, insurance, interest, labor hired, pension and profit sharing plans for employees, rent or lease, repairs and maintenance, seeds and plants, storage and warehouse supplies, taxes, utilities, veterinary, breeding and medicine, and then other. And I give about 6 blank lines there for other. And again, this is expenses paid during the year, during the calendar year that we're reporting on. And it's expenses paid by cash, check, or credit card. Sometimes people pay a farm expense on a credit card and forget to record that as a farm expense. And this is business expenses only, not personal expenses. So a grain to a pleasure horse should be pulled out from the expenses. And you can't deduct everything, all of your home expenses. There's some people think that when you're in business you can deduct everything, and you cannot legally deduct everything. There's a number of expenses that are part personal and part business that take some calculating to figure out the proportions of which. Property taxes is one, and here in Vermont you can generally go to your listers and look at the lister card and figure out how much of this property tax bill is personal versus how much is business. Usually the home is listed right there as a separate item, and then you can figure out the rest of it as business expense by subtracting out the taxes due on the home. With a phone, the last time we had a question on phone, and a phone would go under U for utilities there. The first line, IRS has said that the first line coming into a home is the personal line. The basic monthly fee on a telephone is a personal expense. If you have more services and certain long distance calls, selected long distance calls that were made for business, you can deduct those, but you can't just deduct your entire phone bill as a business expense. You're not supposed to. With electricity is a more challenging one. You might be able to talk to your electric company to get a notion as to business versus personal, or you might have records going back before the business began, what personal, how many kilowatt hours the home used before the business began. Insurance is another one that can be difficult to tease out, and your insurance agent might be able to help you with figuring out how much of that is a business and how much is a personal expense. We had a question on vehicles also before. Keeping track of mileage is the best way to understand vehicle expense, unless you've got a farm truck that's only farm truck. then that farm truck is farm. But lots of people have, there's a farm truck and then the personal vehicle is used as well. And keeping track of the mileage is the best way to do this. Keeping track of personal and business miles with a daily odometer reading. And you can use the standard mileage rate, IRS says is 50.5 cents a mile, or you can try to calculate out your actual expenses, which includes registration and fuel and repairs and tires and all that kind of stuff, plus depreciation times your percent of business use would give you how much vehicle expense to claim. But keeping track of the miles for your business trips is the best way to do that. I'm not going to be talking about business use of the home in this presentation because that's another one that can get pretty involved. Any questions on this one, Mary?
Yeah, actually.
Okay.
You must be psychic. So I have one question about deducting expenses for internet. If you, if you use it for a farm website or email, business email.
A certain proportion of that would be business use, but it'd be hard to imagine that it's only business use on that internet. I would think that the fee for your website would obviously be a business expense, but to claim all of your internet expense as a business expense seems like it'd be a stretch in my mind.
Okay, and then conservation expenses.
Oh, yeah.
Would that include things like brush hogging land that's on the farm but not necessarily used for growing anything?
No. Brush hogging land would just be a regular expense, and if you are doing it using your own equipment, there is no particular expense for it because it would be in depreciation of the machinery, repairs of the machinery, and fuel used in the machinery doing the task. And if an employee is doing it, it'd be their wage. If you're having somebody come in and do it, it would be C for custom hire. And let's see, conservation expenses. I've got the Farmer's Tax Guide in my hand here. There's a whole chapter about conservation expenses, chapter 5, that begins on 27. And it's preventing soil or water conservation, prevention of erosion of land used in farming, or endangered species recovery. There's leveling, grading, terracing land, contour plowing, diversion channels, drainage ditches, irrigation ditches, stuff like that is conservation expenses. And if you're going to claim that, you should take a look at these at Chapter 5 in the Farmer's Tax Guide so that you know what you're doing and doing it right. Another question on that?
No, but I just want to do a quick time check because I see we're about halfway through our slides and 3/4 of the way through our time. So.
Yeah, I got chatty.
Are we ready to move?
Yes.
Okay.
The next one is just a slide showing your the profit and loss from farming. Oh, and I've got a note here that there was a question the last time about mortgage interest. Lots of times farms have the house is on there too, and there's one mortgage on the property. And again, you'd have to be allocating between personal and business as best you can. Let's see. How about the next one, Mary?
Okay.
Depreciation is a using up or wearing out of an asset, and depreciation allows you to spread its cost over several years. I'm not going to get into the lives and percentages and all that stuff. You can read about it in the Farmer's Tax Guide, or sometimes if you're not familiar with this and face depreciation, it might be a good idea to hire somebody to help you with your depreciation the first year to get you into the pattern so that you're set up to do it yourself in years to come. But what you've got to do is you've got to identify it, what you bought, when you bought it, or sold it, what you paid for it or got for it, so that you'll know what your tax basis is so that you can start depreciating stuff properly. There's very specific rules about how many years that you can depreciate something, how fast you can depreciate it, and the thing to remember is the number of years of actual life is not the same as its depreciable life. So this depreciation is not an easy nut to crack. The next slide, please, is depreciation add-ons. There's something that's called a Section 179 expense deduction, and I think of that as instant depreciation. IRS calls it an election to recover all or part of the cost of qualifying property by deducting it in the year that it's placed in service. So under certain circumstances, you may be able to write off the entire purchase price of an asset in the year you bought it. That might be good, and it might be bad. It might be good because you can lower your income or your profit this year because you're increasing your depreciation expense, but it might be bad next year because you don't have that depreciation expense. And then there's something that's called listed property that's handled differently. It's items that have both business and personal use, and it's stuff like cars, computers, and your farm pickup. And there are certain special rules that have to be followed for this type of listed property, and I do not understand those rules. Next slide, please.
Okay.
Sale of business property. If you buy a tractor and use it for X years and then sell it, the money that you receive from that sale looks a lot like selling a ton of potatoes, but the money is handled differently tax-wise. It's because it's usually not a farm product. It's usually been on the farm for more than a year, and there might be an ordinary income, or it might be a capital gain or a capital loss. If it's a capital gain, the capital gains tax rates are generally less than ordinary income tax rates. And if it's a capital gain, you don't have to pay self-employment tax on it. So it's a good move tax-wise to be selling, to have capital gains instead of ordinary income, but there's very specific rules about what's a capital gain. And this is where the records are very important with the date of sale, sales price, and if a trade is involved. It's mainly equipment or animals that have been on your farm for a number of years that aren't being sold, that are sold for breeding or for breeding or something like that, not for beef. Next slide, please.
Mm-hmm.
Self-employment tax, we talked a little bit about this before. That's paid by the owner of the business based on the profit. And in self-employed people are not an employee of the business. A partner is not an employee of the partnership, and a partner in an LLC is not an employee of the LLC. The owner of a corporation could be an employee of the corporation, but not necessarily. There's a special.
So we have.
Yeah.
Oh, sorry, we have a question here that
Sure.
goes
Yep.
back a bit, and I just don't want to lose it.
Yep.
Is there an upper limit to the amount you pay for casual labor where you don't have to do any employer paperwork?
Casual labor is an informal term, and casual labor doesn't exist. I've heard a $2,500 figure there, but because casual labor doesn't exist, it's very difficult to get a real reading on what casual labor is and casual labor amounts. If you read this stuff, somebody is either an employee or they are either an employee of you or they're a self-employed business person that's working on your farm. There is not a casual person on the farm. So That's kind of how that is. I've heard of casual labor, and a lot of people use it, but there is no real term called casual labor. Certain income that you might receive is not subject to self-employment tax, stuff like sale of business property and rental or investment income there. So a dollar looks like a dollar coming in, but it can be handled very, very differently tax-wise depending on what the dollar came in for. Next slide, please.
Okay.
Here we are, hired labor for an employee. Wages, taxes, benefits are all deductible business expenses to you. You can legitimately hire family members. For employees, you're supposed to be withholding federal and state taxes based upon a W-4. You may have to be paying federal and state unemployment tax. Those are larger employers. And you will have to be withholding federal Social Security tax, and then you'll have to be paying those taxes to the feds on a regular basis. You can get in a lot of trouble if you use that money to operate your business with. Boy, there's some big fines for that. And the law in Vermont is that there's an agricultural exemption for ag workers, that farmers can have a payroll of up to $10,000 in a year and legally not have workers' comp insurance, but you are liable for injuries suffered by somebody if you don't have workers' comp. And once you get into this hired labor business, the employer has many responsibilities to employees. So you've got to watch it, because once you hire somebody, there's a different legal formal relationship happening here that may not be obvious to you. And there are a number of people and businesses that just do payroll for people. I know some farms that call in to their payroll service every week, say how many hours each person worked that week, and the payroll service sends the check and does all the calculations and withholding and all that stuff. There's lots of people try to say, well, this person isn't an employee, this person is an independent contractor, and again, IRS has a series of questions that they ask to try to understand the relationship between the business and this particular person. Well, the level of control is very, very important. Who says what hours this person comes in? Who says what this person's going to do? Who says how they're going to do it? Who's providing the tools? Stuff like that. And after your farm gets to a certain size, you need to have more people around, and hiring labor is one of the things that makes the country go around. You know, this unemployment rate and all that kind of stuff. But that first employee is expensive. There's no doubt about that. Next slide, please.
Okay.
Employees, if you have employees, you've got to get an employer identification number. And we talked about this, employees, you control them. And then the independent contractor bit, we just talked about that. Oh, and then this independent contractor, if you have somebody coming onto your farm and you pay them more than $600 in a year, you're supposed to be giving them a 1099 miscellaneous so that IRS can track the money that you paid to them and make sure that those people are claiming the money that you paid to them on their taxes. And there are fines that IRS can levy if you are supposed to have given somebody a 1099 because you paid them more than $600 and you didn't. So they are very concerned about this. Oh, and then what's not listed here is that if you do hire somebody, you're supposed to fill out a so-called I-9 form on them that says that these people are legally able to work in this country. And you can find the I-9 online. It's just called Google form I-9 and you'll find it. Next Next slide, please. Owner's labor. This can be a difficult concept here where owner does not get paid a wage or salary because the owner of the business is not an employee. Owner takes a draw from the business that's not taxable, but the owner gets a profit, hopefully, that's a return to their investment and their time, and the owner pays tax on the profit. And so the profit doesn't necessarily equal the draw that the owner took from the business, but the owner pays tax on the profit that the business makes, not on the draw that they pull out of the business. So it's kind of a funny concept, but this is how self-employed people operate with their business. Next slide, please.
Okay.
Estate tax. Now we're getting into some of the other taxes besides income tax. Estate tax is if you die with lots of assets, your heirs may have to pay an estate tax, and if you don't like this tax, you call it a death tax. The federal was just changed up to, so now that if you die and have an estate that's worth $5 million, there's no estate tax due. If you die and have an estate worth $5,000,001, there would be an estate tax levied on that $1 and any amounts greater than that. In Vermont, this is another typo. In Vermont this year, if you have an estate worth more than $2 million, not $2.5 million, but it's $2 million, there will be an estate tax levied on your estate by the state of Vermont. And a number of states do have estate taxes, some states don't, and this has been a huge political football, and it's going to get kicked again in another couple of years because the fix that the feds did on this in December was just a couple of a year fix. There aren't very many estates that actually wind up paying this estate tax. There are a few farms in Vermont that I'm aware of that have had to pay estate tax, but most farms invest a little bit of money in estate planning and don't have a problem with this estate tax at all. And this is tax that the heirs would have to pay. Next slide, please. Then there's a few specifically Vermont taxes. One, there's a change in this homestead declaration. In years past, all residents have had to make this homestead declaration, but we don't have to do that in 2011 unless there's a change with where you live or a change in the use of the building on the property. In Vermont, we pay property taxes to the town. Farms and forest land are eligible for something that's called use value appraisal, so that if the gross sales from the property are more than $2,000, or if you have at least 25 acres, you may be eligible to have the value of the property come down to its use value instead of fair market value, and the property taxes levied on that property come way down. There's maps that have to be done. If it's forest land, you have to have a forest management plan, and the applications are due in Montpelier by September 1. This program's been going on for 15 or 20 years now, so there's a lot of people that have a pretty good handle on that. We mentioned a sales tax, but there's no tax on food. The Vermont Department of Taxation has a real good website right there, www.state.vt.us/tax. Next slide, please. Do it yourself or professional? Who should do your taxes? With the Building a Sustainable Business class, Mary and I had an enrolled agent doing this presentation. her questions were, have you been doing your own taxes? If you've been doing your own taxes and fairly comfortable with it, you might be able to handle doing Schedule F for your farm without a problem. You might want to hire somebody for the first year or two to guide you through the thinking process, and then you might be able to go back to doing it yourself. With this hire someone for the first few years, you might just hire somebody to help you with depreciation and employment taxes for the first couple of years until you get your mind wrapped around it and you might be able to handle it. Or you may have an aversion to numbers and say, I do not want to do this. I'm going to hire it all done and just do it. And if you want to do that, that's fine too. But the purpose of this evening's webinar is to help you be familiar, at least with taxes and tax law, so you have a notion as to what's going on and that it's not just some kind of magical process that's happening in the tax person's office. And they should be asking you some questions about your goals for the farm and how you want to handle depreciation, whether you want to do it quicker or slower or what. And there's a number of questions and things you should be talking with them about. TurboTax program is not like talking with your professional, because TurboTax doesn't ask you, do you think you're going to be more profitable in 5 years than you are now? If so, perhaps we should slow down your depreciation so the assets that you buy this year, you're still expensing in a few years, and different things like that. TurboTax can't ask that stuff. How do you choose somebody to work with as a tax professional? Talk to your friends, talk to people that you know who are in your same business, find out who they use. Sometimes there's signs hung out on the end of driveways that say taxes or Joe's Tax Service or something like that you drive by. You can stop in and talk with them. I know that in the local paper here in St. J. and in one of the shopper's guides, a lot of the people that do bookkeeping or accounting or taxes have ads in there, particularly at this time of year. Ask your friends. There's 3 levels of tax preparers. Up until last year, or up until this year, anybody could do taxes. But now, starting in 2011, IRS is making an effort to register all preparers, and there's going to be some exams, and there's going to be coursework that these people have to do. There's another level of preparers that's called EA, Enrolled Agents. Those people are licensed by the IRS. There's a large exam, and there's requirements for annual instruction and education. And then CPA, Certified Public Accountants, are licensed by the state, and not all CPAs do taxes. All enrolled agents do taxes because they're enrolled to practice before the IRS. The cost of having your taxes done is a legitimate business expense, and again, you're supposed to allocate it between business and personal. And then the last slide, 15 minutes too long. More questions, check out the www.irs.gov and take a look at the www.ruraltax.org website as well. And are there any other questions out there?
Yeah, I've got a couple here for you. One is on, and then we'll wrap it up. And we'll have to have a part 2 at some point, I guess. Okay, I think this is a current use question.
Oh, yeah.
If gross sales are greater than 2,000, but you have less than 25 acres, can you get use value taxation?
Yeah, I think it's that dollar limit or.
Okay.
Yeah.
And then this one is complicated. Let me read it exactly. Can employee housing be counted as a business expense and not claimed as a profit by the worker if your family member is the employee living there?
Yeah. Yeah, I just had that same question the other day with a farmer whose daughter is 27 and is a farm employee living in a house owned by the farm or owned by the farmer, and that's exactly the situation. The farm claims the expenses on the house, and it's a non-taxable benefit received by the employee.
Perfect.
That's the last one?
Hang on just one second. What I'm doing is posting a web link to the evaluation for tonight's session. If you all would be so kind as to take a couple minutes to fill that out, it would be hugely appreciated. And I want to thank you all for hanging in there with us, particularly since this one has been so problematic to get off the ground, and I'm thrilled that we were able to get through it.
Yeah, I'm delighted. Yeah, how many people?
We had 27.
Awesome, great. Thank you so much for staying with us, folks.
So, yes, thank you. I hope you all picked up a couple of things. And somebody wanted to know, yes, we will make sure that the recording is available, so you can go ahead and review it, just in case you want to see this again and again and again. We'll get you the slides a handout of the slides so you can use that. Do take a look at the irs.gov page, because that's very helpful, and the ruraltax.org as well. Phew. And with that, thank you, everybody, and I guess we'll say good night. We're a minute over. Thank you, Dennis.
Hope it's a great year for everybody.
All right. Drive carefully heading home.
Bye-bye.
Bye.
The host has left the meeting, so at this time, the meeting will come to an end. Thank you, and goodbye.